This is Jody Trana with Chapter 2, Part 2 of Principles of Accounting. I hope you are beginning to learn these things about debits and credits. Debits are not good and credits bad, or credits are not good and debits are bad. They're not positive or negative. They're not the same as adding or subtracting. They do reflect double entry accounting. Here I have a graphic that represents our account categories and the accounts within them. As you can see, our debits do equal our credits. And in accounting, what we're trying to do is accurately report what is inside each one of these accounts. If we need to move something out of assets because we no longer have it, we also have to remove something out of liabilities or out of equity so that we balance. We can move something from one asset account into another asset account, and in doing that, we also still stay in balance. We're going to be talking today about the process of moving information out of one account category and into another account category through journal entries. Let's review the accounting process. First of all, transactions occur. Remember that not everything that happens in business is a transaction, such as if we open the doors for business or if we do a handshake agreement with someone on the price of a product. Those would not be transactions. When a real transaction occurs, there will be a source document, such as if you write a check in payment of a bill, you will have both a copy of that bill and a copy of that check. Those transactions are analyzed to determine what account categories are affected and what accounts within those account categories. And then the transactions are journalized. That means we write a journal entry that has both a debit and a credit in it, and then we post that to our ledgers. Here's another way of looking at the journaling and posting process. Step 1, we want to identify the accounts and the account type. Are we talking about assets? Then we know that the normal balance is on the debit side. Or are we talking about liabilities and equity? Liabilities are credit balances, and many of the accounts in equity are credit balances, although our withdrawals account and our expenses account are both debit normal balances. Step 2, we need to decide whether each account that's being affected, and we always have 2 accounts affected, at least 2, we need to know whether each account is increasing or decreasing. So we need to understand if it's a normal balance of a debit, we're going to be debiting that account in order to increase it. Step 3, we need to record the transactions in the journal. That means writing a journal entry, which we'll talk about shortly. Step 4, we post that journal entry to the ledger. And then step 5, we need to determine whether the accounting equation is still in balance. Let's go through these steps looking at a transaction for Smart Touch Learning. First of all, we want to determine whether this is a transaction. On November 1, the e-learning company received $30,000 in cash from Sheena Bright, and the business issued capital to her. So absolutely this is a transaction, and we need to post it in the journal. The first step is to identify the accounts and the account type. I'm always looking to see if our transaction affects cash, and that's the first thing I look for here. And absolutely, cash is affected in this transaction. I always have to post to 2 accounts every time I make a transaction and write a journal entry. So I need to search the information for the other account. Let's look at it again and see what happened. So on November 1, the e-learning company received $30,000 in cash. And what was that cash for? It was from Sheena Bright, and in exchange for that cash, they issued capital to her. Capital is our second account. Here we see that Sheena Bright is given ownership of this business, and right now she has $30,000 worth of ownership in the business. The second step in the process is to determine the increases and the decreases in the different accounts. So we know that cash and capital are affected. We also need to determine, are they being increased or are they decreasing? Well, since the company received cash, the cash balance is being increased. And also, Sheena Bright's capital is being increased. So what does that mean for debits and credits? If we take a look at our accounting equation expanded with T accounts, and we look at our two accounts here that are going to be affected, let's start with the assets. Remember that the assets account has a normal debit balance. If we want to increase that account, we need to add another debit to it. So a debit on top of a debit will increase that account. If we look at the capital account, remember that the capital account is an equity account, and it's the primary equity account, so it has a credit balance. In order to stay in balance, we already know we're going to debit an asset, so we can credit the equity side, and that will increase our equity. We'll be increasing both assets and increasing capital by debiting one account and crediting another. Each one of our journal entries will always have at least one debit and at least one credit in order to stay in balance. The third step in the process is to record a transaction in the journal with a journal entry. So this may be your first look at a journal entry. I want to show you the different pieces of it because actually it all is very important. First of all, number one, you need to have a date, and we don't normally need to put a year because it would be 1 year of a particular year's journal. So everything in that journal would be for a particular year. We do need to date the transaction. Then the second thing is we need to identify the debit account. We always, always, always write the debit account first in our journal entry. So the account that we're debiting goes on the top, the very first line of the journal entry. Here we write the account. In this case, it's cash. And then in the debit column, we would write the amount that we want to increase that cash account for, which is $30,000. Number 3, we're going to write the credit portion of our journal entry. Notice, please, that the credit account is indented. So right underneath cash, notice that Bright Capital is not lined up with cash. We always indent, always indent our credit account. It helps us to see when we're looking at the entire journal. It helps us to really identify where the journal entries are. And then we also enter that $30,000 into the credit column in order to increase our capital account. The fourth element, and the absolute least favorite of anyone in accounting class, is the explanation. The explanation, although annoying because you feel that you have your journal entry done, the explanation in real life can be the most important part of the journal entry. In it, you'll provide information about the entry and what the entry was for so that you can do some research if you need to. Here, for example, we might enter in the check number from Sheena Bright's check that she wrote us. We might enter some brief conditions as to the agreement, things like that, that could be really helpful in the future. We've done a journal entry, and all the journal entry says is that this is how I want to change my accounts. We haven't actually changed the accounts by writing this journal entry. So we need to make adjustments to our accounts that reflect these journal entries. I want to go back to my original graphic for a minute so you can see the intent of the journal entry that we have just written and that we need to post to our accounts. Remember that our accounting equation needs to balance, and right now our Smart Touch Learning company is sitting with absolutely nothing in its assets, liabilities, or equity. The journal entry that we have written will establish a cash account in our Smart Touch Learning business. But we can't just record the cash, or our accounting equation would be out of balance. We also need to post the credit side of our journal entry into equity to establish Sheena Bright's capital account. Now our accounting equation is in balance. Let's take a look again at the journal entry. Remember that step 3 is to actually write the journal entry. The journal entry is the portion here you see that says November 1, cash is debited $30,000 and Bright Capital is credited $30,000. Step 4 is to actually post that journal entry to our separate ledger accounts. The debit gets posted to the cash account and establishes the cash account for the very first time, since its balance right now is 0. And we post the credit portion of the journal entry into our journal ledger for Bright Capital. This also establishes the capital for the first time because the capital account was 0 before. Take a close look at these T accounts for a company whose transactions, their journal entries, have been posted for the months of November and December. You'll see, for example, in the cash account that there were many increases. These are all debits into cash. And you'll also see that there are decreases in cash. We can track one of these decreases. So first of all, let's look at the November 1 $30,000 entry. That's our initial capital contribution from Sheena Bright. On November 2, we have spent $20,000. You can see that coming out of cash. If we quickly look down the list, at the bottom of the list, we see that we have an entry also on November 2 of a debit to land. November 2's transaction was to purchase land, which credited cash, that reduced cash from $30,000 to $10,000, and it increased our land account, which was 0 before, and now we have a value of $20,000 in our land account. Each one of these transactions has been posted as a debit and a credit to all of our accounts. You're seeing here just the asset accounts. Now you can see all of the liability and equity accounts. See if you can find the Sheena Bright capital account that was established on November 1. It looks like on December 2, Sheena Bright has increased her capital contribution. That's great.